We have three excellent panelists. I will introduce them each as they speak, but only briefly, because if I read out their bios, you wouldn't be able to get any of their wisdom, because there wouldn't be time. We'll start out with Ruben Mamdani, who is the Deputy Director of the Independent Evaluation Office at the IMF, which produced this marvelous report. Few institutions, I must say both public and private, like to have evaluations of what they're doing, both for its timeliness and for its impact. And this is one of them, as Jean-Marie said earlier. And Ruben will lead off, as he is the author and I think director of the report. He's joined here by his colleague, Nancy Wagner, who is here, who is one of the co-authors of the report. You should feel free to add in, particularly in the discussion. Ruben, as I said, has been with the IMF. He's been director of the World Bank's research arm, and he will speak for the next 30 minutes on the substance of the report. So the floor is yours.
Thank you. I prefer to use my hands when I speak, so that would make it easier. So, can you hear me? Excellent. Good morning. First, thank you to the Woodrow Wilson Center and doing No Rules for inviting us to speak about our assessment of the IMF performance in the run-up to the crisis. I'm glad that Nancy, who is the co-author of this report, is here, and also Sanjay Gar, who is the author of one of the background papers, which I will refer to later, is here as well. The financial crisis that exploded in 07-08 and the consequences of which we're still seeing made it more clear than in a long time the importance of having an organization like the IMF that is able to help countries coordinate their policies in addition to help finance when there are difficulties in some countries. It is because of that that it is more important that such an organization will be effective as was set up as its main mandate at the time of its creation. In complicated parlance, that the main mandate is called surveillance, which is assessment of countries' policies, sharing them with the countries, with others, and calling for corrective action when that is needed. So our study, we see it as a contribution in the direction of improving the performance of the effectiveness of the IMF, so that in facing the next crisis, it may not, hopefully, have the same problems that it had going into this one. I will say a few words about what is that this evaluation asks, what our main findings are. I'll dwell a little more on the conclusions and diagnosis, and I will emphasize our recommendations, since that is what is ahead of us, and that's the area where we're looking forward to all of you contributing to bringing about reform. We focused on the period 04 or 07 and to 07, which is the time in which the weaknesses and vulnerabilities that brought about the crisis were mounting. In fact, by sometime in 07, the crisis was probably inevitable. It could have been mitigated perhaps, but it was almost inevitable. And by 08, hell had gone loose. I will say a few words about the questions, and then I will share with you the findings from the three basic pillars that build our evaluation. First, multilateral surveillance, which is when the fund looks at the whole global economy, mostly through two vehicles, the World Economic Outlook and the Global Financial Surveillance Report, which is, they are the two main reports where the fund passes its views on macro and on finance. Then I will talk about what we learned from the surveillance, studying the surveillance in the United States and other financial centers that were at the center of the crisis, and then I'll say one or two words about surveillance in other countries. Okay, what are the main questions that our evaluation addresses? First, we asked a question that perhaps by today is obvious to everyone, which is, was the IMF effective in detecting and warning about the risk and vulnerabilities that brought about the crisis? As all of you know, the answer is no, otherwise we wouldn't have had such a big crisis. Not because the fund would have changed the policies, because the fund only acts by proxy, but because probably countries would have reacted and adjusted their policies. The second question is if it was possible to identify these risks and vulnerabilities. To answer that question, I will bring examples, both from outside the fund, but also from inside the fund, of people that were more prescient than the fund was. Third, I will ask, what were the main factors that brought to this failure of the IMF? And then, what could be done? So, as I mentioned, we built our study on three pillars. On this global pillar, what we learned is that the fund had an overly sanguine banner message. Let me bring you back to that period. The economy all over the world was growing on a sustained manner. In fact, many people were asking whether the IMF is needed at all, because it looked as if boom and bust were a question of history. And in that general mentality, that general approach to economic cycles, the fund took also a very sanguine attitude. The WEO, the World Economic Outlook, focused, like a laser beam on the issue of global imbalances. That, in our view, was an appropriate focus, but it didn't need to be the sole focus. And at a minimum, one should have been analyzing what were the financial impacts of those imbalances. The GFSR that looked at the financial sector did point at some of the vulnerabilities that eventually brought about the crisis. But it did it in a hot pot. It was pointed out to a million things, and among those million things were some of those important vulnerabilities. This doesn't detract from the fact that they saw it, it just detracts from their effectiveness. So much so that even though it was pointed in one important report of the fund, it wasn't picked up by the other one. So it clearly was not going to be picked up by people outside the fund. I have examples. Just let me put this slide just to motivate your reading the report, and you can see that you can pick up a copy outside. I'm not going to go through all the examples, but we brought examples that indicate very pointedly that the fund is not concerned about those vulnerabilities. Okay, what was the message of the fund on the United States? Again, the focus was on the current account deficit. As a solution for that, it was suggested there should be fiscal retrenchment. This is not at the center of this evaluation, but that's strange since in a different part of the fund, people have focused on the fact that private savings were more of an issue than public safety. But the main issue is that financial sector weaknesses, those that brought down the US economy, were seen as a strength and not as a weakness. The fund was actually calling for faster and more innovation rather than taking a step back and seeing how innovation needed to be channeled into the right directions through appropriate regulation. And he had a sanguine message about the housing sector. Whenever, most of the time not with much concern, and when there was concern, he was mellow by saying, but this is, even if it explodes, it will be very low. And this was true until mid-07, so pretty late. What do we learn from the experience in the United States? Well, the fund basically went along with the Federal Reserve's view. We checked very thoroughly whether there had been censorship, whether the US authorities had forced the fund to change its message, but we really didn't find anything. Not the authorities, not the staff thought that had been a big issue. What we did find is that some staff felt that they needed to self-censor. And that is an issue that all of us probably, is a situation that all of us probably have faced at some point in our lives. They found that the highest peak of its involvement in the United States probably has 6, 7 people working on the United States full time. Well, I've been asked to talk into the microphone, so I guess I have to sit down. While the US authorities have thousands and thousands of economists that look more or less like the same economists that the fund has. So it would take an enormous degree of self-assuredness and probably arrogance to take a complete different view, even though that's the reason the fund exists, to be able to take a different view in the face of what looks like authorities that are very convinced that they're doing the right thing. In addition to that, there was a blind trust in the self-correcting nature of financial markets. And there were internal issues, such as failure in the review process, as I mentioned before. Some people within the fund were seeing the problems, the GFSR was seeing some of these problems, and this was not integrated into the work of the US team. How about in other countries? I would like just to point out to one issue, which is the fund, until the crisis exploded, was preaching to many countries reforms in the direction of bringing those countries' financial sectors to be more in line with the US. Extreme examples probably are in Canada and Germany, where even as late as 06 and 07, the fund was trying to convince the authorities to move more in the direction of the financial sector model of the US. And those authorities actually didn't heed the fund advice, and they believed that that helped them cope with the crisis better than otherwise. Okay, what are the main findings of all these 3 pillars altogether? First, the fund failed to warn about the risk of vulnerabilities that brought about the crisis, that the banner message of the fund was very benign, that when some risks have been identified within the fund, they were like presented in the middle of a lot of other issues and not highlighted. The fund was appropriately focused on the issue of global imbalances, but it was doing that, with a single focus, when at that time there was more than, as we know now, more than one risk that needed to receive attention. The review process of the fund failed to connect the dots across the studies that were done in the institution, and very little attention was at that time given to spillovers and contagion. So, was it possible or not? Was this a black swan, or this is something that people that would have taken a more open-minded approach may have been able to see? So in the report, we have a lot of examples of people that were more prescient. Some of those examples are, of obscure academics. That still is important, because if it was possible to do it, you could do it. But we also have some people that were well known to the fund, including the deputy governor of the ECB, Schiller, and Rubini, who actually lectured at the fund, and people within the fund. The financial counselor, the economic counselor, and documents that were prepared within the fund departments that basically described many of the risks, or all the risks, that eventually materialized. So the big question is why? How come a group of probably the brightest, or among the brightest 1,000 economists in the world, working with more or less the greatest access you can have to information on a global basis, how come they missed this crisis that some people believe is the biggest crisis since the Great Depression? So we bring about a list of reasons, which I think that we could classify into two groups of important reasons, and one other factor, in fact, didn't appear to be so important. First is cognitive biases and analytical weaknesses. Second are issues of governance, and what the dog that didn't bark is the political censorship. Okay, cognitive biases is a very big word for behavior that we all know. The first one is that we all feel more comfortable within a group that thinks more or less like us. Most people, at least, feel more comfortable in a group that is similar to us, thinks like us, and saying the same messages as everybody else. That's human nature. And to create incentives to go against human nature is very difficult. So the fund is composed by the staff of the fund is composed by largely macroeconomists that have been trained more or less along the same lines of macroeconomists in most other developed countries and even in emerging markets, and that feels very comfortable aligning itself with the authorities in those countries. I'm not focusing on analytical weaknesses. This is not about the fact that they couldn't
analyze the issue properly. It's just a question of behavior. We all tend to align ourselves with people that act like us, that think like us. Second is the issue of intellectual capture. And intellectual capture means that basically you align yourself automatically with what some other group of people think. In this case, it's the Fed. In fact, it's not only the Fed. The fund tends to align itself with the central banks in many, or I would say most advanced economies. Again, this is a very natural behavior because the fund would have a couple of economists working on each of these countries. You show up at a central bank where you know that they have hundreds, if not thousands of people working on exactly the same topic that you have covered over the last 3 months, and they have been covering day in, day out for all their lives. So the degree of conviction that you have to have in an alternative view to the world that they bring you has to be very, very high for you to raise it very, very strongly. In addition to that, there were like blind spots. There was a conviction that a major financial crisis was unlikely to occur in an advanced economy, as opposed to an emerging market. The truth is that having had several experiences in the last 10, 20 years, one should have been more open to that possibility. And in fact, the fund itself was concerned about a serious financial crisis coming from the global imbalances. But it seemed to be that there was a blind spot on the idea that the financial sectors would all collapse and bring the economies down. And finally, on this category of issues, there is that the profession in general and the fund in particular was very weak on analyzing the links between macro and financial problems. And the fund, in fact, had this separation. You have the wheel that focuses on macro issues and the GFSR that focuses on financial issues. So even structurally, it was organized to reinforce, or is organized to reinforce this analytical weakness. Let me point out at some of the highlights of each of these beyond what I just said. On the governance and organizational issues, let me focus on the fact that there are strong disincentives to speak truth to power. But that, to some extent you can say, well, why are you saying this? Is everybody has a strong disincentive to speak truth to power, perhaps with the exception of the IEO, where we are paid to speak truth to power. Perhaps if we were paid for something else, we would also feel uncomfortable doing that. But it goes beyond that. I'll touch on this a little bit when I talk about the political constraints. But within the fund, the incentives to conform were, during the period that we studied, stronger than just what comes from the groupthink, just from what comes from the natural behavior of human beings. If you are a contrarian, you find yourself isolated. That actually is true in most organizations. In fact, we convene a very high-level advisory group to work with us on this study. Their views are reported in one of the background papers. And I was surprised that many of them said, in my organization there were people that were warning us about this crisis or that crisis for several years, 4 or 5 years, and when the crisis came, they got promoted. their colleagues that have conformed throughout their careers have been promoted 4 times in the same time, during the period in which the crisis did not occur. So in fact, those that had conformed were the ones that promoted those that had warned. So, incentives are not only in the fund in that direction. We just specialize on focusing on the fund. There are silos and third parties in the fund. Anyone that worked in a bureaucracy probably has never heard of this. It's the only place where they are siloed. Now, I have to tell you, tearing down silos not only is difficult, but it may be a bad idea. Because silos are a very efficient way of producing widgets. When you want to, Henry Ford made a fortune creating a silo production system. The problem with silos is that the moment you want to see something different than the regular widget that you produce, a silo is unable to do that because everybody is focused exactly on what they do 1,000,000 times. So one needs to find a way to manage having an efficient production system with sufficient openness so that you can detect this type of crisis. And finally, the fund is a very insular organization. We're doing another evaluation which will come out in the next couple of months, on research in the fund. And we found that citations in fund papers, this is even in the research, not only in the policy work, often are not only 90, but often 100% focus on studies done within the fund. We have one example of a study on private sector development in India, where there wasn't one single site of citation of any work done on private sector in India. This is a country where you have a few economists working on private sector development. So this is just one example of the insularity. Now, one again can understand why this is an insular organization, because when you are dedicated to deal with crisis, most people within the fund, their biggest, their most important experiences were in dealing with crisis, usually in smaller countries. You create a political core that it is not conducive to bringing other people's views. Okay, this is the dog that didn't bark. I mean, we checked about political pressure. No, we really didn't find any. So it's very hard to elaborate about what we didn't find. So if you have questions, we can tell you all what we did to try to look for it. But what we did find is that people self-censor themselves. And we found one angle in which that may be justified by pressure from the members. And that is that there were examples of member countries, not the United States, asking for mission chiefs to be removed because they were giving the messages that they didn't like. Fear is a very, very powerful and very, very contagious disease. So if one person gets hit, that spreads very, very fast. And even if in many occasions authorities may have asked for changing some member of their team, and the fund did not react to that, what is better known is the one case where that worked. So perhaps that was behind the self-censorship. But at the end, we did not find any censorship. In some, there were no clear warnings. That probably already moved. Some other people were more prescient but were ignored. Groupthink, intellectual capture, and governance problems were behind the weaknesses that lay behind the failure. And what I haven't said is that many of these weaknesses have been identified in earlier crises. I have to tell you that our work was made a lot easier thanks to the work that other people had done in previous crises. There were reports. We're lucky that some of those reports were done before the fund had its transparency policies, so they were not well known. So Nancy and I get the glory of having written a report that builds a lot on what other people have already said. But what is a little shocking is that, you know, the same problems still are there. The reforms that were supposed to take care of it, and people say, we have already done it, we did it all. And the same problems, it's not that, because there will always be problems, but the same problems show up in these crises. Okay, the way forward. The fund has already taken many steps to address these weaknesses. And Ranjit, who is here from the IMF, probably will elaborate on that, so I will skip that. But they have taken many, many steps. But are these steps enough? We think that not, that they don't address the cultural shift that is needed, and that they don't bring sufficient accountability for implementing, for getting results out of the reforms that are there. And therefore, they don't guarantee that 10 years from now, hopefully 10 years from now, when the next crisis hits, the fund would have done a better job. We believe that governance changes are critical. The fund structure doesn't have sufficient clarity in who is responsible for that and how people are going to be held accountable for doing what they are supposed to do. That's true at the level of the board, management, and the staff. We believe that it is necessary to put in place a better monitoring and evaluation system within the fund in general, but in particular to monitor the implementation of reforms that are done to deal with this crisis, to see if they are yielding the results that are expected, and if not, to take corrective actions. Otherwise, nothing can, we don't know if our recommendations, even if applied all of them, will yield the results that we want. What we do know is that after 1 year of implementing them, you will be able to see if you're going in the right direction, and then you will be able to perhaps take corrective actions. And finally, we think that on the governance area, that there is a need to recalibrate the fund's approach to risk assessment. The fund systematically errs more on the side of calling too many risks and vulnerabilities in low-income and emerging markets, and too few such vulnerabilities and risks in advanced economies. So perhaps a recalibration of that is in place. We have 5 clusters of recommendations. The first 3 have to do with the ability of the fund and fund staff to detect and state the messages on risks. One is that people should be able to more freely speak to power. 2, that the fund needs to have a consistent message that is the same when you deal with the macro issues than with the financial issues, when bilateral and multilateral, with advanced economies and with emerging markets. And for that, you need to have greater candor within the institution. People should be able to pick up their mind. Then we have one cluster that deals with how to bring about more teamwork. And finally, there is one about the analytical issues of better integrating financial and macro assessment issues. And this latter point is where we believe that the fund is making, at least is more eager in making progress than on the others. Let me just give you, we believe that fund staff and management are better probably prepared than us to identify specific measures of how to implement these clusters. You know, they know the business better than we do. There are more of them, and they're probably smarter than we are. But just to illustrate what we mean by each of these clusters, we gave some specific examples. And let me just mention one or two of those. We believe that there is a need for a self-assessment at the institutional level of the fund. This is very common in corporations in the private sector after the Enron debacle that was introduced in the corporate sector. This is quite common in other international organizations. This is not being done in the fund. We believe that there is a need to integrate better the messages of the WIO and the GFSR, and we see no reason why the fund should not come with a single statement on its views on the global economy that is obviously then internally consistent. We think that in order to encourage candor and diverse views, you need to seek the views of others, probably bring outsiders to talk to the board of the fund, but also that perhaps a unit could be created of people that rotate in and out from there, probably from outside the fund, just to be looking at the big concerns. This is not about creating bigger and better models to identify risk. This is just to bring a complete different view, a different perspective. People that are outside of the group think, outside of the process of creating the widgets that the fund creates.
Let me then turn to Damon Silver, who's director of the policy department at the AFL-CIO. Each of the discussions has 15 minutes, so we can open up for discussion because there are a lot of experts in this room too, and not just an audience. So Damon, the floor is yours.
Good morning. I'm required to say at least the next 4 or 5 days when I talk about matters related to the financial crisis that I'm also the deputy chair of the Congressional Oversight Panel for TARP, and my comments are mine and not the oversight panel, not theirs, not the staff's, etc. We go out of existence, and therefore you may be the last people to get this particular caveat. It's really a great pleasure to be here and talk about this report because and it's sort of ironic in a way that Ruben ended his presentation. One of the bullets at the end of his presentation was somewhat critical of the IMF for not having a evaluative process here, because this evaluative process, the one that you've just heard about, is, as far as I am aware, unique among the major institutions that failed during the financial crisis. In the work that I've done on the oversight panel, one of my particular obsessions has been the absence of this type of self-assessment and the absence of what one might expect to be accountability that would follow from self-assessment at institutions like the Federal Reserve, in particular the Federal Reserve Bank of New York, the Securities and Exchange Commission, the OECD, the Office of the Comptroller of the Currency. Each of these institutions pretty clearly failed abysmally to do its basic functions during the period between 2004 and 2008, and seems to be moving on as though they had succeeded wildly. And it's really, I think, a great tribute to both the people involved in creating the Independent Evaluation Office, the Independent Evaluation Office itself, and the people at the fund who appear to have cooperated in this report. I didn't hear anything that suggests that people refuse to talk. That this document exists and this process has been undergone. As I said, it is unique as far as I can tell. And that's really a very disturbing fact about the current state of financial regulation and global governance, both in the United States and in international institutions, the fact that this report is so unique. So having sort of established that, I want to move on to sort of make a set of comments both about what the analytic findings were and what the conclusions one would draw from those are. although we don't have a formal assessment of this kind for some of the institutions I mentioned a moment or two ago, I think one thing that's clear from this report, which is not unique to the IMF, is that there were people inside the fund who, quote, saw it coming. They may not have been the majority of the fund staff, and their views may have been a little hard to find if you were looking in, say, 2006 or 2007 at the fund's publications, but those people were there. By the way, this is not unique. I mean, I think people who know who Ned Gramlich was at the Federal Reserve played a similar role. And then there are people in the outside world, of course, one of them sitting next to me, who spotted some of these things pretty much on the time frame that one would expect, as Ruben said, a collection of the world's 1,000 smartest economists to figure it out. So what happened to those people? Now, I think it's clear from the report, and what happened to those views? It's clear from the report that those views were, at best, downplayed in the fund's publications and work. It's particularly striking to me, I'm going to make 2 points about this. One, it is particularly striking to me, having looked closely at the events that brought on the financial crisis, not so much that the fund was oblivious in 2004 or 2005, because at that point you had to be fairly, say, focused on, say, the U.S. residential mortgage market and thinking 4 or 5 steps beyond that. And there were people who did that, and Ned Gramlich was one of them. But what's really striking is the fund's posture during 2007. And I'll tell you a little anecdote about 2007. I happened to be with one of the very top officials of the Treasury Department on the day that the two Bear Stearns MBS hedge funds failed in the spring of 2007. And I'm not going to tell you who this person was because I actually have a great deal of respect for the team and so forth, and this is not going to make them look good. I turned to this person and said to him, "Is this something we should be worried about?" Now, I wish I could say that, like Dean, I had understood that the housing finance was going to kill the world economy. I didn't. I was worried about hedge funds as a source of systemic risk, and because of the amount of leverage that we believe hedge funds were laying on. And so I said to this high Treasury official, "Was this something to be worried about?" And I remember as we were walking to the elevator, he said, No, he said, "There's just a couple of idiots at Bear Stearns." Now, between that, I don't believe he was lying to me. I think that's what he thought on that day. But by September 2007, that same person was terrified and knew what was coming. And I talked to him at that time, and it's a whole different deal. I mean, he didn't say that the world financial situation was going to completely collapse, but he was very worried in the fall of 2007. Between those two dates is where anybody who had real data and insight figured it out. So you could say in the end of 2006, well, maybe you didn't understand. By September 2007, everybody understood. The only question was how bad was it going to be? And so where was the fund during that period? I think that question requires, I think, more than what is in this report. And that's not a criticism per se, it's just an observation about detail. Secondly, I want to talk about this notion of political influence and political power. Ruben made a point several times of making clear that he couldn't find any instance of active political muscle wielding to alter fund conclusions or fund analysis. And I'm certain that that's true, but I think we need to understand how limited that statement is. And limited in two senses. One is that, as he pointed out in his presentation, self-censorship is rife in all bureaucracies and all large institutions, and people understand which way the wind blows and what kind of things get rewarded and what kind of things get you ignored, left in a little cubicle to write to yourself. You don't need political muscle to enforce a regime like that. But secondly, and with respect to the fund, I think there's a critical thing to understand here, at least that I've, in my very limited interactions with the fund, come to appreciate. The channels of political influence into the fund from the fund's major member countries do not go through unwilling conduits. You only get the person telling an oversight body that there's been political muscle when that person has themselves felt the pressure of being forced to do something that they don't want to do. If the channels of that kind of political force are exerted through essentially agents of those countries within the fund itself, you'll never hear about it, because it will never be perceived as anything like coercion. So I think we ought to understand just what a narrow conclusion this is, and how difficult the real nature of the political problem here is to uproot. Now I want to make a couple of comments about intellectual issues. It's really striking to me that, at least from looking at this report, that no one at the fund appears to have ever looked at some very basic numbers about things like the housing market in the United States. The ratio of housing prices to incomes. But this is the most simple number. And it clearly, starting in 2003 or 2004, showed a bubble developing. Now, I don't know what the explanation for that is. Maybe it's, maybe the group think all that explains it. But it would be interesting to know what the answer is of the 1,000 smartest economists in the world as to why they didn't look at specific numbers. And perhaps Ruben knows the answer, can tell us in a minute. And then finally, a point about in terms of intellectual issues, a point about perspectives. The document makes the very a point that, and I think they cite Paul Krugman for this point, that economists tend to like elegant theories over data. And what I think is striking, and I think that's a valid point. It's a really interesting thing about the difference between social sciences and physical sciences. There's a long history that elegant theories in physical sciences actually turn out to be true. The opposite is true about social sciences. Something to be kept in mind. What does turn out to have some relevance, I believe, and here I reflect my own intellectual sort of ancestry, is some historical perspective. And it's clear, I think, from this report that that was completely lacking. And I think it was made clear in what Ruben said in his presentation. We did have some hints of what was about to happen, and some patterns that we could have looked at, the fund could have looked at. For example, the high-tech bubble in the United States. My view that in certain respects, the financial crisis of 2008 and the mortgage bubble and the high-tech bubble that preceded it are all one phenomenon. One could also look at the S&L crisis in the United States, very, very similar. There's a decent argument that the United States made a I think there's a decent argument, so speaking historically, that the United States made a structural shift in its economy in the late 70s and early 80s, and that all of these things are the consequence of that structural shift. The S&L crisis, the high-tech bubble, long-term capital management, U.S. interaction with the Asian financial crisis, and finally, and hopefully finally, the 2008 crisis. Now, having some people who think historically around someplace in the building might be helpful. Now, what can we conclude then about all of this? Looking forward. We saw the slide that Ruben put up of all the things that have been done by the fund to try to integrate financial and macroeconomic analysis. And perhaps all that'll work out great. However, at the moment, I think the threat sort of lies elsewhere. But these same issues of groupthink are very much on the table. The issues that are facing the fund today, and in its interaction with other international institutions and major economies of the world, really go to the issue of, is this crisis over? And is it the right response to if the crisis is over, and I think that's a really big if, and I don't want to associate myself with agreeing with that proposition, I just want to say that that's the kind of mentality we're in right now. If the crisis is over, is it a good idea to revert to essentially the set of economic nostrums that the fund was pushing as the crisis developed? Right? Is it the right idea to move today? Is it the right idea to move today toward fiscal austerity and the destruction of economic security in the world in those countries that have any for working people? Is it time to do that? And two, is it ever time to do that? Now, from what I have seen of the fund, I would say that in contrast, for example, to the OECD, there's a live argument within the fund about this right now. But that live argument, and the fund did an event, 2 weeks ago here in Washington, that really put that argument on stage in a big way. But that the fact that we even that if you step back a second and remove elements of groupthink and all the things that are in this report, this conversation, the fact that there's another side to this argument, the fact that there are folks who are saying, let's just go back to the agenda of 2006 and 2007 at the IMF, that's a completely intellectually untenable position. It has no intellectual support at all. It is the consequence, it is the living embodiment of political influence and groupthink. Now, and of course the stakes are very, very high, particularly if you believe, as I do, that we're not really out, that the crisis is not really over. Certainly from the perspective of the people who pay my salary, we talked about people who pay people's salaries, 15 million unemployed in the United States, the highest level of unemployed worldwide ever been measured, in terms of just the count, the head count. Again, in the United States, we've had 3-4 million families thrown out of their homes. We expect to see 13 million before it's over. Right? That suggests it ain't over by a long shot. But by the way, those are Wall Street estimates. They're not, the AFL-CIO's independent estimates. Those things all suggest a crisis that's ongoing, and I'd be happy to talk in greater length about why I think that's true about the financial sector, in addition to in terms of what workers experience. And so the last question I think that this report raises is, if the fund remains in a posture where where essentially, for one reason or another, right, it's the major member states effectively, if even simply through intellectual means, dictate the way the fund thinks. Two questions, I think, have to be posed. First is, if you look at the fund today, after all these events have occurred, and if you look at who is doing what at the fund, and occupies positions of influence and who doesn't, would a rational person conclude that groupthink and obedience to the more powerful member states was or was not a good career strategy? It really representing literally the millions of people just within the American labor movement who had lost their jobs as a result of these failures. I don't mean by the fund specifically, but there are tens of millions, perhaps hundreds of millions of people worldwide who have lost their jobs. Other than, I can't recall any policymaker at the professional level in either the United States government or international institutions who's on a food line. I don't know where those people are. And this is not merely a matter of like social justice, this is a matter of institutional effectiveness. As Ruben points out, no private corporation would function this way, or at least none that don't have unique kinds of protections would function this way. Of course, some that have unique protections have functioned precisely this way in the United States and perhaps some other places. So that's question one. Question two is, how does the IMF structurally become a more intellectually independent institution? Right? These recommendations, outside advisors, self-assessments, they could be very helpful. I should point out that our Congressional Oversight Panel made precisely the outside advisor recommendation to the United States government in our financial reform report that Congress asked for. Many aspects of that report are embedded in Dodd-Frank. That one is not. There is no body of independent experts that will be advising the United States government as to where the next economic crisis will come from. Perhaps you'll have better luck with the fund. But it's not at all clear to me that given the fundamental structure of the fund, that these types of recommendations will be sufficient right, to undo the subtle sort of combination of intellectual and political and career incentives that I think this report has done such a good job in illuminating. And it may be too much to ask of the Independent Evaluation Office that they should put forward those deeper structural reforms, but somebody ought to. I'll stop there.
Good job for new rules. Dean Baker, as many of you know, is co-director of the Center for Economic and Policy Research. If I read his publications list and his bio, we can go on forever. But I will simply say that if you don't read his blogs, posts, you should do so immediately because they're extremely useful. And if you want to give them the access to it, I'd be happy to have you do so. And let me turn it over to you.
Okay, thanks. I appreciate the opportunity to speak here. I'll give you my, since you did the plug, okay, through www.cepr.net, and I have a blog, Beat the Press, that you can find on our main page. We also have a CEPR blog that I'll advertise as well. I appreciate the opportunity to be here, and I appreciate having Damon speak before me. He made a lot of points I would want to make, so it gives me a chance to go off on some different ground. I'll also say I really do want to compliment the Independent Evaluation Committee, and like Damon, I just wish we had this for the Fed, for the Treasury, for the Securities and Exchange Commission, on, and it is very nice to have that as a model. Having said that, naturally, I'm going to say you guys didn't go far enough. The 3 points I want to make is, first of all, that this was a crisis that was easy to see, and I'll go through the basic story quickly, but I emphasize the issue that it's a housing bubble. There was a financial crisis, but I'm going to emphasize the housing bubble. I think that's first and foremost the fundamental story here. My reason for saying that is housing bubbles are simple, financial crises can be complicated. The second point is that it is important to understand there were other tools. This is a point I make in passing. There's other tools than the interest rate. So I don't know how many times I get into arguments, debates with economists, and I go, oh, so you would have wanted the Fed to raise interest rates. And I say no, and then they go, you would have wanted the Fed to raise interest rates. No. That's a last recourse. I want to talk about the other tools. The other tools don't work, then you raise interest rates. Then I want to pick up the point that Damon made, perhaps in passing, but I really want to drive this home. There have to be sanctions. That means economists get fired. I'll let you think about that one for a moment as I go through the other 2 points. It always strikes people, you usually think I'm joking. I'm not. I'm an economist. We believe in sanctions. We believe in discipline. If you mess up on your job, you get fired. All right, well, to start the basic point, easy to see, as I said, I think it's a housing bubble. I'm not saying that to be contentious. I look at the economy today, and, you know, Damon's pointing out that we have 25 million people unemployed, underemployed, giving up work, looking for work altogether. We have millions of people who've lost their homes, millions more who will lose their homes. And I go, how would that have been different if we did not have the financial crisis? What would be different today? And basically, I'm pretty hard-pressed to say very much. Okay, I don't doubt, I'm not disputing for a moment that if, you know, we could have thought of worse scenarios. If we go back to September, October of 2008, we could have thought of worse scenarios. You know, so we kept the financial system operating. That was a good thing. But if we look at the economy today, given that we've had a plunge in house prices, which was caused by the collapse of the bubble, how would it have been different if we didn't have the financial crisis? I don't see any fundamental way it would have been different. So that's why I emphasize the housing bubble. It's not just to be contentious. I really do think that that's true. And I understand it's an international story. The housing bubble was not just a U.S. phenomenon. There were bubbles in Spain and Ireland and England. Most of the OECD countries, not all of them, Germany for better or worse, escaped that. And there were a few others. But and it took different forms. But, you know, but it was a story, first and foremost, to my mind, of a housing bubble. Now, in saying that, it astounds me. This was not something you had to be hugely prescient to see. We had a 100-year-long trend in nationwide house prices in the United States, 100-year-long trend in the largest market in the world, where house prices just tracked inflation. That's a real long trend in a really big market. My reason for emphasizing that is, you know, as an economist, usually we just look at post-war data. If we have a trend for 30 years, that's a big deal. It's 100 years. And it's a large market. You know, you could have erratic movements in the price of chrome or zinc. We all understand that. You know, these aren't huge markets. Things affect them, you know, in odd ways. It's a huge market. Okay, so what was it that led to a huge divergence in house prices by their peak in 2006? House prices adjusted for inflation were more than 70% above their long-term trend. So what explained that? You'd think as an economist, you'd want to go, okay, well, what was this? And I followed this closely, of course, and I first actually started following this closely at the instigation of Alan Greenspan when he said there was no bubble. That was 2002. And at that point, house prices had already risen by 30%, adjusted for inflation, above their long-term trend. And he said, well, there's been a big growth in income. You go, no, there hasn't been a big growth in income. You presumably know better than that. He's the chair of the Federal Reserve Board. He has data. There was good growth 96 to 2000, but that didn't exceed the growth in the post-war boom period, 47 to 73. And of course, we had the recession in 2001. Income had stopped growing, was shrinking. That made no sense. He talked about population growth. Well, again, come on, Alan Greenspan knows population trends in the United States. He mentioned immigrants. Immigrants are buying $450,000 homes. But on top of that, everyone knows that the demographics of the United States are dominated by the baby boom cohort. So if you want to talk about a housing bubble driven by population, that should have been the 70s and 80s when the boomers were first forming their own households, not in late 90s and 2000s. That made no sense. Supply side, he talked about the environmental restrictions on building. It wasn't exactly the heyday of environmentalism, and limited supplies of buildable land. Again, there's always been limited supply. There's always been a limited amount of land in Manhattan. That wasn't new in the late 90s. So this literally made no sense. Now, if you wanted to buy the fundamental story, you'd look at rents, right? So if there really are fundamental factors driving up house prices, there's got to be something going on in rents. So what was going on in rents? Well, rents outpaced inflation by about a percentage point, 96 to 2000, and then they were totally flat. Nothing going on with rents. That should have bothered me. The last part of that story was that you had record vacancy rates already as early as 2002. That's not consistent with the run-up in house prices being driven by fundamentals. This is 2002 we're talking about, not 2005, 2006, 2002. Okay, and it only got worse, of course. Now, I don't understand how you missed that. To say, oh, it wasn't my job, how'd you miss that? That's kind of amazing to me. This was a really, really big deal. I don't understand how you missed that. And again, I'm most familiar with the U.S. market. You can tell comparable stories for Spain, for many other countries. I don't really understand how that is missable. The last part of the story, I had a number of people tell me that, well, we could have dealt with this, so what if house prices collapse, no big deal. Well, again, a little arithmetic. I'm really fond of arithmetic. I always think that all the economists in Washington were so smart they skipped directly from second grade to fourth grade because they don't seem to know third grade arithmetic. The basic story here was you had about 5% of GDP tied up in construction, extraordinary rates of construction, that was going to disappear when the bubbles burst. There was also a bubble in non-residential. I won't get into that. But about 5 percentage points of GDP. We also had consumption being driven by an $8 trillion housing bubble. I talk about the housing wealth effect, and I get economists look at me like this is some crazy Marxist invention. I learned this in grad school first year. I thought everyone knew this. I don't know. It's not an alien concept. So you have $8 trillion in housing wealth created by a bubble. That led to somewhere around $500 billion a year in annual consumption that would not be there when that bubble wealth disappeared. Now, I don't know anything in economics that tells me where we're going to replace 10 percentage points of GDP in a short manner. Now, if someone knows that, please tell me. I've never heard it. I don't know how you do that. It should have been easy to see that this was going to be a really, really bad story. The bubble would burst. It'd be a really bad story. Financial crisis was a likely outcome. It was a very likely outcome. Again, you'd look into specifics, and, if you did that, of course, you would see exactly where it would occur. But losing 10 percentage points of demand of GDP, that is not going to be easily replaced. That is a very, very bad story with or without a financial crisis. Okay, second point, interest rates. I always get this story that, okay, you want to raise interest rates. Well, the economy was weak. The Fed was right in leaving interest rates low in 2003, 2004, 2005. I was at the A in January of 2004. And I went to one session where Alan Greenspan was patting himself on the back for, being so smart and just letting the stock bubble rise and collapse of its own accord, and everything worked out great. And then I went to a next session, and Ben Bernanke, who at that time was on the Fed as a governor, explained why they still had a 1% discount rate or a federal funds rate because the labor market was so weak. Those two are inconsistent, but no one seemed to think that. In other words, we actually did have a lot of fallout from the stock market crash. It took a long time for the economy to recover. They were right to leave interest rates low. The economy was very weak. What else could they have done? Well, I always said the first thing that the Fed could have done is talk. And I don't mean Alan Greenspan mumbling irrational exuberance. What I mean is putting out the information. They can ignore me. They don't have to pay attention when Dean Baker says there's a housing bubble. When Alan Greenspan says there's a housing bubble, not just, no, he thinks there's fraud. No, he puts out the data. We have an unexplained run-up in house prices. People have to pay attention. That would be the focus of national debate. And there was no other side to this argument. I debated a lot of people, the chief economists at Fannie and Freddie, a lot of other people, they said nonsense. I have a hard time believing that the Federal Reserve Board had devoted its staff to documenting and publicizing the existence of the housing bubble. That would have had a serious impact. Also, just other things, the Fed does have regulatory power. They didn't finally come out with their guidance on mortgage issuance, what was the summer of 2008? I mean, this is a joke. I mean, things like, when banks issue mortgages, they should assess someone's ability to pay based on a reset rate, not on a teaser rate. I mean, these are kind of stupid things, but, it would have been helpful if the Fed had done even minimal steps, much less cracking down on fraudulent loans, which were widespread and easily to see. I had access, I knew of this, and I don't have regulatory powers. It's hard to believe that the Fed, people at the Fed did not know. The last point of that is, I would have raised interest rates as a last call, that, if at the end of the day, the Fed had pulled out all the stops, they put out all the information, and the market still ignored it, house prices continued to go up, I would have raised interest rates. That certainly would have been better than letting the bubble continue to expand. But you first take the steps that you have available that don't have the negative consequences, slowing the economy, that interest rates would have. Okay, the last point, and I really do emphasize this, it's not a joke. If we're economists, we should believe people respond to sanctions. And there's a large literature on the importance of firing. In fact, the OECD, I've argued with a lot of the OECD, they're very unhappy that you have employment protection legislation in most countries other than the United States. You can't just fire someone in France and Germany. You have to establish that they didn't do their job. So it's not easy to fire people. And they argue that's a bad thing. You should just be able to fire people. Well, these were people that really did not do their job. This was not a minor mistake. This is the school bus driver who comes to work drunk, drives into oncoming traffic, and all the kids get killed. And then they come back into work the next morning and go, how you doing? I mean, this is kind of amazing, but the idea, that you would fire anyone, we get this, who could have known? Well, who could have known should not be acceptable. An economist that was doing their work did know or would have known. And we have a lot of economists, obviously not just at the IMF, at the central banks, at other institutions, that did not know they should face serious career consequences. And again, this counters the groupthink. You will change groupthink a lot if your answer to why didn't you see it was, oh, Joe over there didn't see it, or my boss didn't see it. No, that's not acceptable. You're paid, these people are paid pretty good salaries, a lot better than most people in this country, hell of a lot better than most people in the world. They should be able to think independently. If they're not, well, why don't we just hire a kid out of high school and pay him the minimum wage? So I'm very serious about that. If you don't have people that get fired making a complete disaster like this, I don't see how we can expect any change in behavior. If we don't have people at the IMF and other institutions thinking that if they don't do their job, if they don't think independently, they face a real risk, then they're going to do the exact same thing that they did before this crisis. They're going to do what their bosses want them to do. They'll keep their mouth shut. They won't speak truth to power. And the only question is, when does the next crisis come? So I'll stop with that.
Our last speaker is Ranjit Teja, who's the Deputy Director of the Strategic Planning and Review Department within the IMF. The floor is yours.
Thanks very much. I'm going to talk a little bit about how the fund has been responding to these critiques. This critique is not new to the IEO. The fund has not been coy, I would say, from the first day of the crisis to acknowledge that it did not see this coming, that there was a rather severe failure on the part of the fund's economists to sort of raise the issues that Ruben and Dean and others have been talking about. So let me say a little bit about what the fund has done over the last 3 years, and also address the issue of whether it is enough or not. Okay, so the most important step, I would say, that we have taken in the last 3 years is to institute what we call an early warning exercise. In the past, the fund used to look mainly at emerging market economies and risks and vulnerabilities over there. And that exercise has worked quite well. In fact, although we don't publicize the results of this exercise that all the staff undertake, the fact is that there are almost no countries that currently are under IMF programs that were not flagged as vulnerable. So I think it works very well. The big step we have now taken is to move this on to advanced economies, and we have a rather elaborate exercise. We have kept it confidential. It's not made public, and that is a point that is taken up in the IEO report. Maybe this kind of stuff really should be made much more public than it currently is. Our thinking is that once it becomes public, we will be, as staff, under severe pressure to water down things. I've already experienced that in the course of this exercise. So that is something that we are mindful of. But we do believe that there should be some way, some sanitized version of that early warning exercise that can be made public. That exercise may not rise to the Achtung level of warning that many people would want. I don't think that's realistic in any bureaucracy, but it's pretty candid and straightforward, and I certainly view it as a step forward. A second important change has been to make financial sector assessments, which, by the way, were not undertaken for the US for a variety of reasons over the years. To make those obligatory now for the 25 largest financially systemic countries. And thirdly, to institute what we call spillover reports, which is a discussion of how policies in one country affect another, and thereby have a more honest discussion than we tend to have about how problems spill over from one country to another. For example, in the United States right now there's a very strong debate of whether an easy monetary policy is hurting emerging markets or not, by pushing capital to those countries, by raising commodity prices and so forth. And there really has not been a strong international debate about this. So this is something that we are putting on the table for discussion. Another one concerns regulatory policies. There's been a lot of effort to strengthen banking norms through Basel III and so forth. But really this crisis has not spread through standard banking channels. Most of the action occurs through non-banks, what we call the shadow banking system, investment banks and so forth. And if there really is a regulatory issue to be addressed, it's in this shadow system, because that is where the transmissions occur from one place to another. And that is also an important theme that we have been pushing in the fund. There are a number of other initiatives. I won't get into all the details, but the main point about them is that they target systemic economies. This has been a major grouse amongst many of the fund's membership. There is not an even-handed treatment. Ruben mentioned that there's a lot of surveillance of critical surveillance of emerging markets and low-income countries, and that this has not really extended to the larger systemic ones. I think we would agree with a lot of that, with that assessment, and in fact this is very squarely targeted at remedying that. Now, if you were to ask me, do we think that these changes that we've set in motion, do we, the staff and management of the IMF, think that it's enough? The answer is a clear no. We do not think it's enough. And so we have put forward some of the proposals that were in the IEO report. For example, to have some kind of institutionalization of professional skepticism. We do agree that it would be a good idea to have somebody from the outside in real time, not ex post, critique the fund's surveillance So to have some system by which we can have the Schillers and the Rubinis and the Rajans of the world critique IMF surveillance in real time, not exposed if they are so inclined. What we see as the advantage is, on the one hand, it puts the staff on notice that not just some gadfly, but really somebody well respected is going to be assessing you instantly. And at the same time, the political authorities at the executive board are also going to think twice to be excessively defensive. So far, this proposal has not met with a lot of traction, so I'm not sure how far we're going to go. But from staff's side, although even within staff, obviously we have mixed feelings about this kind of setup. We are pushing it, and it's to be seen where we get. Now, there was a point made in Ruben's presentation also about the importance of reviewing what we do. The IEO report sort of has pointed out the failures and focusing mainly on the United States and the United Kingdom. But we are now we have a 3-year review process for IMF surveillance, which we call the Triennial Surveillance Review, and that will be coming on stream this September, where we will be looking at the performance of IMF surveillance over the past 3 years across the membership. And the focus of this review is specifically on the integration of systemic risk issues and bilateral surveillance, our normal country surveillance. As part of this process, we also have a number of outside authors, including, I can't tell you who they are, but including people who are well-known critics of the fund. So we do see this process as something having started. We don't have insta solutions that we can put out there and fix everything in one fell swoop, but I think we do have a process in place and a mechanism of accountability for whether these things, whether these proposals for reform are being implemented or not. Let me just briefly touch on a few other points that were raised by Dean and others. There was this point made about data versus theory, and that's somehow economists are too much in love with theory and not enough with facts. Now, I can relate to this point. The idea that, for example, fund economists thought that financial innovation was a risk diversifier and not a risk concentrator and amplifier. I think that is correct. But we do think that data does have a role. There are a lot of misperceptions about the kind of access the fund staff actually does have to data. We do have a lot of access to fiscal data, monetary data, and so forth. We do not, and I really want to stress this, we do not have access to financial data. We do not have any means at the moment for what we call creating risk maps of cross-holdings between different kinds of financial institutions. This is a point that we have been pushing as part of the discussion last year of the IMF's mandate. And that is to find ways for us to get hold of confidential regulatory data. You will not be surprised to hear that nobody wants to give us this data with any kind of assurances of confidentiality and so on. And we get it's routine for us to get skeptical comments of, well, what would you do with this? How would you even know what to do with this data? And markets change every day, and so on and so forth. Nevertheless, just to prove a point, we actually bought some data and showed that a lot of the transmission of the crisis occurred through, as I said, the shadow banking system, and many countries that you don't think of when you're thinking finance, Ireland, and so forth, are indeed quite central to any understanding how crises are propagated. And so this is something also that we think is quite important to push on. So maybe I'll stop there and we'll be happy to take any questions. Thank you.
Thank you very much. I let this run because I thought it was extremely stimulating. But we're now open up for questions. So as we're being recorded for webcast, I'll try and recognize alternate people on each side, or people from each side, put it that way, not alternate people. And I'd ask you to keep your questions or observations if you want to make them, but keep them brief and we can get as many of you in as we possibly can before we have to break. So who would like to lead off? I've got lots of people. Good. Let me just start with the young woman here on the right. And if you could identify yourself, that would help all of us.
Yes. Hello. I'm Sandrine Rastel. I'm a journalist with Bloomberg. What I appreciated in the report was the footnotes on particular country cases like China, Latvia, and we were talking about political constraints or the lack of, but you could see that countries really resisted in having even their Article 4 reports published, and Latvia in particular in the run-up to the crisis. I was wondering, now that the G20 is counting more and more on the IMF to do a lot of things and is asked to be more and more candid, how do you reconcile these two things?
Either one of you want to reply?
Yeah, well, it's, countries insist that they maintain the control. Who is the IMF really? It's not just the economists at the fund. It's really who controls the IMF, and that's the executive board, the country authorities. They want to retain control of whether something gets published or not. The issue is, one of the recommendations in Rubin's report was that to give staff independence, you need to allow publication of the staff reports without passing through the filter of the executive board. Well, that didn't get a lot of traction. I think that's something that we made quite clear. How do we reconcile it? We're not going to be able to reconcile this in any easy way. In my experience, I just want to say this, I've worked on many countries. The problem of political interference, as I think one of the panelists mentioned, is a very subtle thing. I would say that I would agree with the IEO report, not this one, some years ago, which pointed out that it's a problem endemic to all large economies, not just to industrial ones. I've worked in many countries around the world, and I can tell you that there are that issue cuts across the membership. We find now the good news is that most reports do get published, and even the China report, the last one, was published. People have hang-ups about how the staff characterize certain developments, and that sort of stalls publication. But most of the time, the issue also concerns whether there's something that could be market sensitive. And these are all reasons why countries withhold permission from publication.
We'll go to this side here.